The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Shaking off a deadlock in peace talks, live from Studio 2 here at Bloomberg headquarters in New York. I'm Katie Greifeld.
And I'm Isabel Lee. We're kicking off through the closing bell here in the U.S. on this Monday. And this is where we stand. An S&P that's higher by 0.6%. It's actually climbing to its session highs. And this comes after U.S. President Donald Trump said that Iran still wants to have a deal. And this comes also after the blockade in the Strait of Hormuz. 10-year yields, you're looking at 4.29. And Brent, this is the big story of the day because it fell below the $100 per barrel, but it's still up by more than 2.5%. So investors are really on edge on what it will mean if the Strait of Hormuz remains blocked, because that will impact their oil supply. And lastly, Bitcoin. This is an interesting story. It's up now by 1.5%, but ever since February, Bitcoin has really been just between 65,000 to 73,000. So Katie, is it a hedge? Is it a haven? Who knows?
Right now, it looks like it's just range bound. But to your point, when you take a look at this market, it definitely seems like Wall Street is acting like those unsuccessful peace talks in Pakistan this weekend aren't that big of a deal. Morgan Stanley strategist Mike Wilson pointing to resilient earnings and continued economic recovery, acting as a sort of shield for the S&P 500 and masking a broader pullback in equities. Specifically, Wilson's team points to the Russell 3000 as a better measure to assess the current stock retreat, with more than half the stocks in that index down at least 20% from its peak. But today, the S&P 500 is higher, flying after President Donald Trump said that Iran still wanted to make a deal. The president blaming the collapse negotiations on Iran's insistence on maintaining a nuclear program. The renewed hopes of more talks coming hours after the U.S. moved to cut off vessels from transiting the Strait of Hormuz. And volatility from the war in Iran, it's already showing up in earnings, boosting Goldman equity traders to beat their own previous all-time quarterly high by more than $1 billion. But that record, not enough to offset disappointment from the bank's surprise drop in bond trading revenue. On the earnings call, we heard CEO David Solomon addressing the themes that the bank dealt with during the previous quarter.
2026 began with a degree of optimism. Markets hit record highs, confidence continued to build, with most clients focused on growth, strategic activity, and capital deployment. As we've said, things rarely move in a straight line. And as the quarter progressed, the macro environment started to weigh on sentiment. Volatility increased meaningfully amid concerns around AI-driven disruption in sectors like software, heightened uncertainty in parts of private credit, and the conflict in the Middle East.
Let's kick things off now with Paul Christopher. He is head of global investment strategy at the Wells Fargo Investment Institute. Paul, great to have you with us. Just set the scene here, because you think about what we saw this weekend. Vice President J.D. Vance leaving Pakistan empty-handed. Now you have the U.S. blockading the Strait of Hormuz. And then you take a look at the S&P 500 continuing its winning ways. The index currently at session highs. What do you make of the temperature right now?
Yeah, we've seen this, and great to be on your show, thank you. But we've seen this now for 2 to 3 weeks, where even the mention of a ceasefire or a deal gets investors kind of to perk up their optimism and start buying a little bit. It's really hard to imagine how we're going to get a deal where the two sides have these red lines that aren't anywhere near close together. So we would be a little bit cautious in this environment and would recommend rebalancing here, not putting all the money to work.
And, you know, Isabel brought up Bitcoin. It's really been range bound. And then you think about what we're seeing in oil right now, what we're seeing in crude oil. It seems like $100 a barrel thereabouts. It's hard to budge from. And let's assume that we stay near these levels for a while when it comes to crude. I mean, how do you think this market can fare with oil near $100 a barrel for a sustained period of time?
Yeah, for a sustained period of time, we'd worry about it. And the other piece of that maybe that goes unsaid is that if oil stays at $100 for a sustained period of time, it means the talks are going nowhere, probably, and that we should be more concerned about things turning south once again. So, yeah, the high oil prices do weigh on the economy. They create friction. But I would be just as concerned about the fact that your premise there is that we're going to stick there for a while, and that would mean that we're in a stalemate in the Middle East.
And Paul, you argue that this could actually boost earnings. How meaningful is that upside, and could we even see higher revisions from here?
Yeah, look, the sectors that are most adversely affected here by oil prices would be industrials, of course, and retail. But if you look at other areas of the economy, especially tech, but even other areas that have really resilient supply chains or that are service-oriented and not primarily related to oil prices, we're seeing pretty solid earnings across the board in those areas. And the Bloomberg consensus on the S&P 500 is $325 a share. That's even richer than our more conservative estimate of $300 per share. So, yeah, to reiterate the point you made at the top of the show, there we think is some resilience that you'll find in earnings as we move forward here.
And financials are your biggest overweight, and you still like AI trade. Walk us through both of your thought process when it comes to those trades.
Yeah, sure. So the financials trade is really predicated on two pillars. One is that we see the economy growing this year, and yes, it is a midterm year, so there are going to be lots of distractions, but we see the economy growing, and even if the Fed doesn't cut rates further, we do see more upside on the long end of the maturity spectrum, sometimes called the yield curve. If those yields can go up, that means that banks can get more for the loans that they're going to make in a growing economy. We think that's a good place to be for financials going forward. And really, the multiples there look really attractive to us right now compared to the rest of the index.
Yeah, it's fascinating. You take a look at the sector level year to date on the S&P 500. Financials, your worst performing sector in a very volatile year. I do want to talk a little bit about what's going on in the bond market because, you know, especially on the long end of the yield curve, you haven't found much of a hedge when it comes to 10-year treasuries, and certainly yields have just been kind of moving in a straight line higher throughout this conflict. I see in the notes you sent over to our producers that when it comes to fixed income, you're unfavorable short term, favorable intermediate term, unfavorable long term. So a really interesting barbell there. What do you see when it comes to these different timelines?
So with short term, we do think the Fed will eventually be able to get around to cutting rates. The economy will slow from the friction of oil prices. Inflation will come back down. We think that allows the Fed to cut rates probably another 1 or 2 times, maybe not right away, not anytime soon. But we do see some further downside on the short end. And then on the long end, it's just so volatile. There's so many things driving it right now. If you look at 10-year inflation swaps, they are closing the gap. The 1-year inflation swap went up right away as soon as the war started. The 10-year inflation swap has gone up more, let's say slowly, but is now almost to the level of the 1-year inflation swap. That tells us that investors are getting more worried about that prolonged sort of conflict and maybe an oil price at the end of the war that's at $80 or $85 instead of $60 the way it was at the beginning. So that's just the beginning. Then you've got the budget issues for the government, and the longer this war goes on, the more significant the tab is going to be to fight this war. And then, of course, the 2026 budget and those issues that we haven't even begun to wrestle with yet. And so the upside volatility in yields here is something we want to avoid because, of course, if you're an investor and you're invested in those long-end yields and those yields start to go up, that hurts your return even more than it does because of duration than it does in the intermediate section of the yield curve.
I hear what you're saying, Paul, but is there a level when it comes to the 10-year, for example, you know, where you would say now is probably a good time to step in where, you know, it'd be hard to go much higher than this point?
I wouldn't want to try to put an upper limit on that right now. 475.5 maybe on the 10-year, but that would, you know, if we get there, it kind of depends on how we get there. Is it because of inflation and oil prices up to maybe $150 a barrel? If so, then we might be looking at even lower returns in bonds going forward. So we'll reserve judgment on that and stick with our unfavorable position on the long end.
All right, Paul. Well, you knew I had to try. Great to get some time with you. That's Paul Christopher.
Thanks.
He is head of global investment strategy over at the Wells Fargo Investment Institute. Now, coming up, as the conflict in the Middle East shakes markets across the globe, we'll drill down on the geopolitical and economic implications, particularly to the world's second largest economy, with Kyle Bass. He is co-CEO over at Rochefort.
And even as the conflict in the Middle East raises questions about economic growth and consumer spending, some areas of the economy are resilient. We speak with Zoetis CEO Kristin Peck about how pet care has improved remarkably in the past years.
And from Iran and consumer concerns to concerns about AI disruption, a discussion on mitigation and the future of the technology with Greg Case, Aon President and CEO. All that and more coming up. This is The Close on Bloomberg.
Shares of Dell and HP jumping on a report that NVIDIA is looking to make an acquisition with a potential to reshape the PC landscape. HP accounts for roughly 19% of global PC market share, while Dell sits around 17%, according to industry research firm Gartner. Joining us live with more is Jin Ho, Senior Analyst of Hardware and Networking at Bloomberg Intelligence. Thank you so much for joining us, Jin. So first of all, how credible is this that NVIDIA would acquire a PC player like Dell or HP?
Well, I'll tell you, I find it highly suspect that NVIDIA would be interested in someone like a PC vendor, primarily more from a margin profile standpoint, but also from a business standpoint. It just doesn't make sense.
So maybe it's not NVIDIA necessarily is what you're saying, but if NVIDIA were to be in the market for one of these companies, one of these PC vendors, I mean, do you think that Dell, HP would be on the shopping list here, or are there other players that might make more sense?
Sure. So from a shopping list standpoint, HP potentially could make sense because they lost their CEO last quarter to PayPal, and they are somewhat rudderless in a sense. But however, they have this humongous printing business that just doesn't match well with NVIDIA unless you want to print more graphics cards. And the PC business, quite frankly, in general, is a very low margin business. It's 5% operating margin versus NVIDIA's 50% operating margin. So, that's why I just find the reports to be suspect. In terms of Dell, however, they are one of Dell's. Dell is one of NVIDIA's suppliers, right? They sell a lot of NVIDIA AI servers. But however, again, I mean, from a scale perspective, that just might be a deal that might be too big to chew.
How does this change the outlook for Dell specifically, given its AI server momentum?
Oh yeah, I think Dell is very well positioned from in the AI server market. And part and parcel, it's because there are only a couple of companies that has the scale that Dell has outside of the hyperscale cloud ODMs. Supermicro is one, but they've also stumbled with their own controversy as well. So they might be able to take some share from Supermicro going forward.
And it's interesting. I mean, you talk about certain industries, and people love to say they're ripe for consolidation. When you take a look at the cohort of companies that we're talking about right now, PC vendors, do you think that this is an industry that sort of falls into this bucket, that this is an industry that should start to see some deal making?
I will tell you, Katie, that there's only of the four companies. I think you at the top you said HP had around 19% market share. Dell had 17. Lenovo has roughly about 20, and Apple has about 10%. But from a revenue standpoint, they have about 25% market share. So the consolidation has largely been done through natural selection. If you are going to acquire somebody, it's probably going to be a subscale vendor.
30 seconds here. Does this validate the idea that maybe PCs are becoming AI devices and not just hardware?
Yeah, you know what? Everything is going to be an AI device. Intel chips are AI enabled, and quite frankly, Isabel, your smartphone is going to be an AI device as well.
Oh, wow.
All right, the future is now. Jin Ho, great to get some time with you. Senior Analyst of Hardware and Networking over at Bloomberg Intelligence. Now coming up, KBW CEO Thomas Michaud, he joins us live to discuss his outlook on the financial sector as bank earnings kick off. This is The Close on Bloomberg. It's time now for our top calls. A look at some of the big movers on the back of analyst recommendations. And we start with Nike. HSBC downgrading the athletic apparel company to hold from buy and trimming their price target by $2 to $48. The analyst says patience has run out regarding Nike's turnaround, saying it's become a show-me story with no short-term catalyst. Shares a little bit higher. Next in line, we have Constellation Brands. TD Cowen raising a toast to end their rating on the maker of Modelo and Corona to a buy and boosting their price target to $190 from $142. The analyst sees upside to Constellation's overly conservative beer guidance given the upcoming World Cup and subsiding pressure on Hispanic consumers. Shares down by about 0.8%. And finally, Caterpillar. Citi is lifting their price target on the construction machinery maker to a street high of $905 and maintaining their buy rating. The raise reflects higher earnings estimates ahead of their first quarter results out later this month. And those are some of our top calls. And speaking of quarterly earnings, the KBW Bank Index saw its weakest quarterly performance since 2023 in the first quarter of this year. Now this, as Goldman stock is down about roughly 2% after reporting first quarter earnings that missed the mark. Our next guest says that we entered 2026 highly bullish, but the outlook has since moderated. Joining us now is Thomas Michaud. He is CEO of KBW. Tom, great to see you.
Hi, good afternoon.
So let's start with Goldman, a bit of a rocky reaction here. And I wonder, does that portend anything for the rest of the big banks who have yet to report this week? Or are we talking about Goldman-specific stories?
I think it's Goldman-specific story. Goldman's stock has tripled over the last 2 years, so it had a lot of good news already priced into it. The stock was trading very close to 3 times tangible book. They did earn 21 on tangible common equity in the quarter, so we think they had a good quarter. We recommend the stock, or we rate the stock market perform because we just think it's fully priced. And I think that's some of the price action today is I think investors really needed a big upside surprise to get the shares going. But 21% on capital is still a pretty good quarter.
And to be fair, I mean, Goldman stock has definitely clawed back from session lows, now down about 1.5%. What's interesting when it comes to Goldman is that, of course, they had a big beat when it comes to their equity trading, but a big miss when it comes to FICC, when it comes to their bond traders. I wonder what you made of that.
The way we look at it is that, especially someone who's a leader at an investment bank, it's hard to get all your businesses to fire on at really high levels everywhere. And I think the key part of these businesses is that they have a lot of diversity to their earnings. So they had a very strong M&A quarter, very strong equities quarter. Their M&A quarter was market leading. So, and then you look at some other things in the balance sheet. They had very big loan growth in the quarter, which 12%, which is something worth talking about. But they provided for this growth. So the loan loss provision was higher than analyst estimates because the growth was higher, even though charge-offs and losses were certainly in line. And then the other thing is they did probably twice as much buyback as the street was looking for. Like, these are two themes I think you'll see when earnings really kick into gear again tomorrow, which is providing for the loan growth without credit losses. So in other words, that means it's, I think, relatively conservative. And then number two is I think the street might be surprised by how much share repurchase is going to happen across the industry. So I think those are very common themes. But remember, too, Goldman gets more than 50% of their revenue from sort of market-based activity.
Right.
Very different than the core banks that we're going to start seeing report tomorrow, even JPMorgan.
So then at one point, does geopolitical risks move from being a tailwind to a headwind when it comes to especially bank earnings?
The bank's earnings. So when I think about this quarter, that's a great question because that's what I've been thinking about myself. So the underlying framework to the bank earnings are very good. The balance sheets are the best they've been in decades. We're having historic regulatory reform around us. Banks are about to recapture a lot of market share from private credit. The stocks are still relatively inexpensive relative to history. We got 11% earnings per share for the group. What changes it is if we have a significant shift in the economy, which is exactly what I think you just asked. War in the Middle East and $100 oil are two possible reasons why it could slow. The interesting thing here is all of our channel checks are showing, by and large, it's not impacting things right now. So I think the first quarter credit quality is going to be very good. We're not seeing it in any loan problems at the moment. Growth in loans is still pretty good. Goldman said M&A activity is continuing. We've got some very large IPOs that are entering the market like now. So the point is the markets are kind of shrugging this off. And so as long as you see the resilience in the economy, the banks are certainly very well positioned. And even if we did run into a headwind, I don't see anything out there that suggests anything about a crisis. It's actually the opposite. The industry's starting whatever the next cycle is in great shape.
And if this geopolitical risks continue, are we going to see traditional heavy trading banks benefit more, or those more in the lending?
Volatility is good for trading organizations, and that's the Goldmans, Morgan Stanleys, JPMorgans, and even some of the regionals, my parent company and others, are all pretty well situated to capture some of that. So volatility is up, and that's good for trading.
But then you take a look at the group's performance year to date. We mentioned this earlier, that you take a look at the sectors in the S&P 500, financials as a whole down 6%. That is your worst performing sector of 2026.
Down 6% from which period?
Year to date.
Year to date.
Year to date. And it's unintuitive given what you're saying, that volatility should theoretically...
So I'm a little bit more addicted to the Keefe Bank Index, so I'm not
sure you would
I'm
be.
not sure which index that is, because the Keefe Bank Index
S&P 500 sectors.
Okay, the Keefe Bank Index, which is the top 24 banks, is up a little bit on the year, outperforming by a little. The stocks peaked in February when it was nothing but green lights. Banks took it on the chin, worse than the market when the war started, but they've come really back strong. But then there's another one.
Right.
The Keefe Regional Bank Index, which is the KRX, is up 8%.
But my question to you is, why that reaction function, given that volatility, as we're discussing, should be good for those trading heavy banks?
I think it's because the feature that spooks investors the most is credit quality. And I think private credit being on the front page of the paper almost daily spooks folks. So let me give you another stat. If you look back over the last decade, we research all these companies. Banks have had a compounded annual growth rate of commercial loans of 3% per year. Private credit has grown at 12% per year, and BDCs have grown at 21% a year. So historically, if you go into a downturn, you tend to look where the growth was greatest first. Doesn't mean there's a guaranteed problem, but managing fast growth and credit quality if a turn comes. Now, we don't see this turn coming. I want to make that clear. And then the other big issue is the entire credit industry, bank and non-bank, is over-earning on credit. The shocker is how low credit costs have been. That just has to change. Over my whole career, credit is a cycle. So you will see credit expenses go up.
All right.
Soon. I don't know about soon. Eventually. I may take back soon. Eventually, I'll take back soon.
Unfortunately, we're up against the clock. Have to leave it there. Fantastic conversation with Tom Michaud. He is the CEO of KBW. Now, coming up, Kyle Bass. He is the co-CEO of Rochefort. He joins the program next. This is The Close on Bloomberg. It's just about 3:30 p.m. in New York. This is the countdown to The Close. I'm Katie Greifeld.
And I'm Isabel Lee.
And President Trump vowing to attack any Iranian vessels that approach the U.S. ships in the Strait of Hormuz as his naval blockade of the waterway takes effect. President Trump's blockade will test the durability of the ceasefire after talks in Pakistan on extending that truce failed to reach a deal. Trump has since said that Iran has reached out to his administration over peace negotiations since the U.S. blockade began. Here to discuss further, I'm pleased to say we have Kyle Bass. He is the co-CEO of Rochefort. Kyle, great to have you with us. And let's just talk about what we've seen market-wide since the start of March, because the S&P 500, we're actually right where we were before the war started. If you take a look at the dollar, we're still stronger. Brent still noticeably higher, and yields sharply higher. When you take stock of the cross-asset action right now, I'm curious if you see any any area of the markets that are overpriced, or any of the markets that are maybe discounting this risk.
Well, Katie, great to be here. I think that when you look at the cross-asset pricing, the markets are flat. Oil's up substantially, and especially dated Brent over there in the Middle East, Asia, and Europe, as well as LNG cargoes in Asia and Europe. And I think that for us to achieve our objectives with Iran, meaning we're not leaving there without the 900 plus pounds of highly enriched uranium that the Iranians said they were never making, and basically not adhering to the number of ballistic missiles that they are supposed to have or are not supposed to have. I think we're not going to leave there without that uranium. We're not going to leave there without regime change, and maybe have some sort of a democratic regime going forward. And I think that's going to take a few more weeks, Katie. So I don't think the energy markets are pricing in what's likely to happen in the next few weeks.
Well, speaking of the energy markets, I want to talk a little bit about China, because you think about China's place in the world. They are Iran's biggest oil customer, also a key trade partner. And I'm curious, in your view, what the U.S. blockade of the Strait of Hormuz actually means for China and their markets.
Yeah, it's an interesting turnabout, right? The Iranians decided that closing the strait was the way to push the pain button in the U.S. as I think we head into the midterms. And in the end, this turnabout has Iran's got 90% of their GDP leaving out of their ports and transiting the Strait of Hormuz. And so I think that it's really important to understand what this causes within Iran. You know, they've got imports that they're not going to receive daily, and they have their entire economy is an export-based economy. And if they've only got about 12 or 13 days left before their oil storage facilities are full. And if their oil storage facilities fill, they have to shut in their wells. When you shut in old wells, a bunch of water rushes in and permanently damages your output. And so their output today was around 1.5 million barrels a day. This could permanently cause 500,000 barrels a day or more of damage to Iran's, call it, energy infrastructure, not to mention that it will strangle the IRGC's capital. You know, our Treasury, our Department of War worked together to seize some IRGC stablecoins, U.S. dollar-backed stablecoins. We're now squeezing the IRGC's, let's just say we're cutting the blood flow off to the tumor. So this turnabout is something that Iran didn't bargain for. It probably wasn't on their bingo card, and it's a brilliant move.
So how then, Kyle, do you think that these talks will progress? Because both nations seem to be firm when it comes to their stances.
Yeah, I mean, it's hard. Look, it's hard to negotiate with a madman, or more importantly, a group of madmen. If you look back through our negotiations throughout time with the JCPOA and Iran's nuclear ambitions, you don't put your centrifuges, 300 meters down in the ground if you're just spinning low enriched uranium. They constantly told us they weren't making highly enriched uranium, that they weren't making a bomb, that they weren't doing this or that. And in the end, we now see that they lied to us the entire time. They haven't negotiated in good faith yet. And so, Isabel, I don't know if anyone believes that Iran will ever negotiate in good faith. But what this does is this strangles the leadership. There are 267,000 members of the IRGC, and there's about 90 million people in Iran. So what we're trying to effectuate change in is that theocratic, repressive, oppressive leadership. We're trying to change that. And at the same time, we are not going to leave without that highly enriched uranium that's only days away from being able to make 11 or 12 big nuclear bombs. And so we're doing the world a favor. This is going to happen. We're not leaving without it. And at the same time, we sure hope that we could take Iran back to the 1970s and have it prosper once again. So that's the hope for what transpires here. But war is unpredictable, Isabella.
Well, Kyle, let's talk a little bit about what this means for markets, what this means for portfolios, because you mentioned that, this conflict as it stands looks like it could last for a couple more weeks. Maybe that isn't priced into oil markets. Then you take a look at the currency markets, for example. I see that the dollar has been weakening against the offshore yuan for just about a year here. I mean, how do you invest around this? How do you trade around this?
I mean, look, what this teaches you is that the U.S. has the deepest, most effective capital markets in the world. We are certainly 60% plus of the market cap of the world. We're only 4% of the world's population, and we're 25% of the GDP. When you start investing in other countries, when you start thinking about places like the Middle East or China, or let's just say other places that don't have all of the attributes of our country, I think you stick with dollar-based investing, you stick with assets in the U.S. I know emerging market assets had a big run last year, but when we imposed the tariffs, maybe the last time we talked, Katie, was shortly after the tariff day.
A lifetime ago.
Last year, yeah, it seems like a lifetime ago. And look, the effective tariff rate around the world for the United States imposing tariffs on others was about 16.5%, and the dollar had like a 10% move. That was a very accretive transaction to the U.S. in the end. We were repricing global trade and those that had kind of taken advantage of us over a long period of time. So going forward, how we expect this conflict to end? I mean, unfortunately, you don't want to hear what I think about this. I believe that I don't believe there's an end to Iran and its illegitimate proxies fomenting terror around the world unless we can actually snuff out the leadership there. And I don't believe there's an end to the Russia-Ukraine war. I don't believe we're going to sign another Munich agreement with someone like Putin. And so now we're staring down the barrel of China potentially attacking Taiwan in the coming years. And so what I'm telling you is the world's going to have more conflict. The financial architecture of the world has never looked this bad while we've been alive. And so the financial architecture of the world doesn't stipulate that we can move back to kind of 3% global GDP growth and we can forget about all this conflict. What I believe is you're going to see more conflict, and I think you're going to see more concentration of assets in the U.S.
And Kyle, before we let you go, I do want to get your thoughts on something more domestic, and that's, of course, what's happening in Texas. That is your home state. That's where we're speaking to you from today. And it's interesting. It feels like the capital markets activity in Texas has picked up quite a bit. You think about the Dallas mayor, I believe, was at the New York Stock Exchange today. You also have the Texas Stock Exchange moving closer to launch. So when it comes to the activity that you're seeing there, is that something that you're interested in investing behind, or how do you see this story and this momentum evolving?
Sure, it's a great question. Look, Texas grows 4.5% GDP. It's got a $2 trillion economy. We're the Tigris and Euphrates of growth in the Western world. And we are one of the if we were a sovereign, we'd be one of the fastest growing sovereigns in the world. When you look at Wall Street, and now we have Y'all Street opening up here, you have many of the Wall Street firms are going to have more employees in Texas than they have in New York. That's something that, again, was unthinkable a decade ago. So we have enormous growth, the states leaning in to accept that growth. Only 20% of the states developed. And the only bottlenecks that I see in the state are power and water. Power can be handled and solved. Water is a much more difficult conversation to be having, and that conversation will be had over the coming years. So it's kind of Texas's growth to lose in the future, Katie, and I think the state's doing an amazing job right now.
All right, Kyle, really appreciate your time today. I hope to speak soon. That is Kyle Bass. He is the co-CEO of Rochefort. Meanwhile, speaking of pivots, we learned that last week the consumers' spending barely budged before the Iran war began, but not in our next guest's corner of the market. Consumers are spending on their pets, driving Zoetis' companion animal business to over 70% of their revenue. The stock, however, still lagging the S&P 500 this year. So let's put it all together with Zoetis CEO Kristin Peck. Kristin, great to have you with us. And it's interesting. This is something that we've talked about before, the fact that consumers, Americans, are spending a lot of money on their animals. But then you take a look at vet visits. They've actually been declining a bit over the past several years. And, I wonder how you square that circle and what it means specifically for Zoetis.
Well, first of all, Katie and Isabel, it is great to be back with you. And yes, the animal health industry is incredibly resilient. And as you just think, over the last 40 years, the average lifespan of pets have increased 1.5 to 1.7 times. And I think innovation is at the heart of this right now. And, even as you mentioned, consumers feel pressure in this economy, and vet visits have indeed been declining. But pet owners' human-animal bond means they're, still willing to spend to take care of those pets. And really at Zoetis, what we're doing is leading in the innovation for both of those pets as well as for livestock and all the protein that people are continuing to consume.
And you're embedding AI across your business. Where is it actually making a difference today?
Yeah, we really see AI as a force multiplier. It amplifies, the power of our scientists, of our veterinarians, and of our teams. And there's a few really big places we're invested. First, as you think about livestock, we have an AI model that can predict pancreas disease in salmon 8 weeks before you can confirm it. And 8 weeks is everything. If you're a livestock producer in a salmon farm, it's the difference between protecting their harvest and losing their harvest. And today, we have AI diagnostics in animal health at your vet clinic, that can let you know as soon as they take a mass out within an hour whether or not your pet actually has cancer, and will put you online again with a specialist pathologist. So that's why I say we really think it's a force multiplier to amplify the strength of both our scientists as well as our vets.
Well, you touched on something I've been wondering about. When it comes to AI in animal care, I feel like that conversation is just starting to be had on a wider scale when it comes to human health. When it comes to animals, is the bigger potential opportunity in livestock, or is it in companion animals?
We're really looking both at AI and genomics and leveraging that to transform healthcare. If you think about it, you can better predict disease. We have genetic tests. You can get base paws for your dog or your cat, or in the livestock side, as you mentioned. And with that insights, you can better personalize the care for your dog. And as you think about on the livestock side, it's incredibly powerful in being able to, create a healthier, more sustainable herd at scale. As you think about, applying that more broadly, it helps produce a safe and affordable food supply. And if you consider the fact that by, 2050, we're going to need 50 to 70% more protein than what we produce today, the need for healthier, more sustainable animals and more productive animals is, more necessary than ever.
And you say that animals are living longer now. This is fantastic news for Katie and also my husband, who are great animal lovers. How much of your growth is really tied towards that aging trend?
Yeah, so we kind of look at it as the longevity loop, Isabel. That's sort of how we talk about it. And pets are living longer, but they're also, pet owners are expecting similar care to what they get. And we're addressing really new unmet medical need. I was on your show a few months ago as we talked about our pipeline. We're going to have 12 blockbuster products, so products worth at least $100 million in new disease areas where there are really almost no products today. Chronic kidney disease and cardiology and oncology. And collectively, that's $7 billion of market value that isn't being tapped today. So, if you really think about it, we're in the beginning of a major innovation cycle across animal health, and we're really proud at Zoetis to have the strongest pipeline to deliver there.
All right, Kristin. Well, really great to check in with you. Appreciate you making the time. That is Kristin Peck. She is the CEO of Zoetis. Meanwhile, we take a look at these markets coming off a winning week for the S&P 500. We had a very consequential weekend of geopolitical risk, Isabel, and it looks like the markets, as discussed, just shaking it off here.
Yeah, we have HSBC Max Kettner saying there's too much focus on geopolitics, but when you look at the markets, when you look at high-frequency U.S. data, they're strong and they're doing well. So, what's there to worry about, I guess, when it comes to markets?
That's true, and it's hard to focus on anything other than geopolitics, given that that is taking up all the air in the room. But maybe as we get into the weeks ahead, there's going to be more conversations about the fundamentals of corporate America as we get deeper into earnings season here.
A U.S. blockade has serious consequences. We have some estimates saying it could cost the Iranian economy $13 billion a month, and some are saying that $4 to $5 of gas will be nostalgia from here on out.
Nostalgia. Well, we're going to put it all together next with Kim Forrest. She is the founder and chief investment officer at Bokeh Capital Partners. That conversation up next. This is The Close.
It's really hard to imagine how we're going to get a deal where the two sides have these red lines that aren't anywhere near close together. So we would be a little bit cautious in this environment and would recommend rebalancing here, not putting all the money to work.
And that was Paul Christopher, head of global investment strategy over at the Wells Fargo Investment Institute, helping us to kick off the show. The S&P 500, fresh off of 2 straight weeks of gains, Isabel, looks like it's climbing ever higher into these closing bells.
I know, when you look at the S&P, it seems like nothing is happening. It seems like everything is blissfully okay, but it's really, there's a disconnect, I think, with real world happenings and what the market is reacting to.
Or maybe just, these risk traders immune to some of the headlines being batted back and forth. Let's try to get some answers here with Kim Forrest. She is founder and chief investment officer over at Bokeh Capital Partners. And Kim, I love this first line in your note saying basically, if you had told me on Friday that we were going to leave Pakistan empty-handed without any sort of negotiated deal here, that it would be pretty surprising to see the market action as it stands today, the S&P 500 looks like it's going to close at session highs. Oil well behaved as well. How are you thinking through these different cross currents right now?
Well, as I always do, is I'm looking at a much longer timeline than a day, that's for sure. But it's even longer than a year. So I'm 3 to 5 years out, and that gives me some leisure to be able to look at assets, at companies, and say, is this a good deal in 3 to 5 years? And I think that answer is easier than what's this going to be worth next month.
Well, to that point, I'm really curious where you fall on software right now. I was talking to Nancy Tengler over at Laffer Tengler earlier in the day. She made the point that, in some of her value strategies, they've actually rotated into software, rotated out of energy, which I think would frighten a lot of investors. But specifically, when you look at some of the most beaten down cohorts of this market right now, where do you see the opportunity?
Well, I think software, and especially enterprise software, is really important. I think the value of them, or the fall in the value of them, is people really not understanding what value software brings. And a lot of it has to do with storing the past. So as I have to sit here the next couple of days and do lots of end of quarter, how did we do sort of work, I rely on Excel, and I rely on old spreadsheets and all manner of old things in Word documents and all things Microsoft, right? AI isn't going to get rid of that. We need Microsoft, if only to access our data of the past. But, it's really more than that. I think the hype behind AI and how easy it was going to be to write software really threw a chill into most investors' minds, and they acted on it. And it feels premature, and maybe today is the beginning of that turnaround.
So the rivalry in AI is getting really more and more intense. Does this feel like early innings of a durable cycle, or does it feel to you like maybe misallocated capital?
I think a little bit of both. I love AI because I used to work in it. I built it. I was a software engineer working at a company called Neuralware that made the first neural networking tools that, you didn't have to write code to use. You could just, put data in and get an answer out. But here's the thing. I think people really don't understand that this is the beginning of it, not the end of trying to figure out how AI works in business and in our life. A lot of people see these large language models and think that they're thinking, they are not. There's a lot of misallocation of capital. But in the long run, which is 3 to 5 years, I think that AI is going to be a productive tool that we all depend upon.
First of all, that is a very impressive tidbit about you. Second, are we looking at maybe peak resilience here, or do you think that this is complacency that could maybe unwind very quickly?
I think, well, looking at how quickly people ditched software that was meaningful, right? Like Salesforce and Microsoft and all these names that companies really depend on to run their businesses on. It is alarming how quickly, a trade can turn against you, and especially if it's being driven by momentum investors. So there's that. So I would be careful, but I would also be careful, be a slower kind of trader as opposed to trigger hair. I think that's my takeaway. And be diversified, so one holding isn't going to kill your results.
I do want to get your thoughts on what we're seeing with banks. Of course, we're just getting into big bank earnings. We had Goldman takes the stage this morning, not exactly getting a warm reception there. But you think about the financial sector overall, it is the worst performing sector in the S&P year to date. And I wonder what you make of that, given that, especially in times of volatility, you would expect some of these big banks would be making big money when it comes to their trading desks.
Well, I think the trading desk is just fine, but it's the exposure to private credit and private anything, essentially. And there's the rub. Private means that they don't price daily, like our life here on Wall Street. And so people don't really understand if the funds that they have are, viable. And that is an issue. And I think we're going to hear a lot more about that, or beginning to at least hear about that during this banking season. I also think there always are banks that are overexposed to risky endeavors, but by and large, I don't anticipate this to be the beginning of another 2008, 2009 banking sector crisis.
And Kim, we only have about a minute left with you. I mean, that sort of brings us back to software, because you think about what started a lot of these private credit concerns. A lot of those fears were born out of the sector's overall exposure to software. So, even long-term, 3 to 5 years, it sounds like you're pretty constructive there. I mean, do you think, though, that could continue to be a headwind for some of these private asset managers?
I think so. And again, remember, private assets are newer companies probably, or companies that probably weren't doing that good and couldn't get debt on, their cash flows. So again, in this world of private debt, they've been going out on the risk curve, and it shows. You were going to get paid back more. That was the theory. And you didn't have the overhead of a big bank. Well, I think they're probably managers that are managing risk well, but we don't know who they are.
All right, Kim, always great to speak with you. That is Kim Forrest. She is the founder and chief investment officer over at Bokeh Capital Partners, helping to count us down to the close just minutes away. You can see the S&P 500 looks like it's going to finish out this Monday at session highs. We're going to break it down with a full market coverage simulcast starting right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Isabel Lee in for Romaine Bostic. And here to help take us through the closing bell, it's a global simulcast. We're joined now by Carol Masser and Bailey Lipschultz. He's in for Tim Stanovic. We bring together all of our different audiences to talk about, Carol, a big rally in the S&P 500. It looks like we're going to finish out this Monday close to session highs, even though we had a lot of geopolitical headlines over the weekends that wouldn't necessarily speak to renewed risk appetite here.
Yeah, it's kind of fascinating to see this trade. It feels a little bit like a blah day, but maybe Bailey will kind of get into that in just a moment. Having said that, you're right, though. We're at session highs, and I'm looking at something like the Russell 2000, those small caps, some outperformance. That index is actually up, Bailey, about 1.4%.
Up 1.4%, as Katie mentioned. S&P right now up about 1%. But, guys, I just want to keep perspective. Trading volumes are lower than they have been. So we are trying to keep things kind of in that light, Isabel. When I look at this market, yes, we are recouping all of those losses from the initial attacks, but volumes are low and we're heading into a critical earnings season.
And beyond geopolitical risks and news, we have earnings seasons underway. Goldman Sachs reported today, and we have a full stack this week from JPMorgan, Citi, BlackRock, Wells Fargo, all set to report tomorrow, and everyone will offer a window into the state of the economy amid everything that's happening.
Yeah, and it was interesting to see the reception to Goldman, and an interesting miss when it came to their bond trading, but those stock traders just crushed it. In any case, you can see that we are setting up for the close here, just a few seconds away. The S&P 500, fresh off of 2 straight weeks of gains, look like it's going to finish this Monday higher by about 1%, matched and then some by the NASDAQ, going to finish 1.2% higher. You take a look at the Dow, it's not really exciting. What can the Dow tell you about this economy? It's higher by about 0.6%. And then we zoom out, we look at the Russell 2000. Carol, as you mentioned, the little guys were the big outperformers today. The Russell 2000 going to finish about 1.5% higher.
Katie, it's the Dow calling, saying, "Why don't you like me? I mean, why?
You're price-weighted.
I know.
What can you tell me?"
I know. All right, let's go back to the S&P 500. Most names in that average higher on this Monday. 357 to the upside, 145 is about to the downside, 1 unchanged.
I keep on going back to what Max Kettner of HSBC said, which is there's too much focus on geopolitics. I mean, company guidance is looking good, and we look at the IMAP. It's really mostly green on the screen. The only thing that's down, at least from my view, is consumer staples, down by 0.8%. The biggest driver, of course, is tech, up by 1.5%.
All right, guys, let's get to, wow, a lot of green. Let's get to some individual gainers in today's trade. Got to talk about Dell and HP Inc. Ticker there, of course, HPQ. We saw both of them rallying. Dell up almost 7%, HP up about 5.3% in today's session. Both of them jumping after a report that NVIDIA was seeking an acquisition to reshape the PC landscape. NVIDIA has been negotiating for more than a year to buy a, quote, large company, according to the website Semi-Accurate. Our Bloomberg Intelligence team have been kind of following this speculation. Dell and HP are among the top PC vendors in the world, HP having 19% of the global market and Dell having about 17% market share. I think our BI team, though, questioning like what this would do to NVIDIA in terms of its growth story. But anyway, investors certainly perked up, and we're following that one. Hey, I want to mention Oracle, too. Some outperformance there in today's session. I think it may have been the top gainer in the S&P 500. Yep. Yes, indeed. That stock finishing pretty much at its best levels of the session, up 12.7%. Company disclosing a new Oracle Utilities Industry Suite offerings to help utilities cut costs with artificial intelligence and improve grid reliability. They also announced a new public cloud region in Morocco, extending its global infrastructure footprint. That coming from Benzinga, putting that information out. But nonetheless, we did see some outperformance there. Again, up 12.7%. And then I want to go to something different. I'm actually, thank you, Finley, for actually saying, let's take a look at the Switzerland shares, because the ADRs that trade here are a little wackadoo. So it's called Polypeptide, ticker PPGNSW, hitting, I think, the highest level possibly, not ever, because you can see that, that's the intraday? Yeah, that's the intraday. But according to people with knowledge of the matter, the company is attracting private equity takeover interest. So EQT, AB, KKR, and Advent are among suitors that have been studying a potential acquisition of the company, and any buyout firm may seek to team up with its billionaire controlling shareholder. If you're not familiar, this company specializes in the development and manufacturing of synthetic peptides related to metabolism.
I was wondering.
Notably targeting obesity and diabetes. And as you know, those are two things that plague a lot of folks around the world.
Peptides are really hot right now. I feel like I see them all over social media, for better or worse.
For your skin?
For everything.
For everything. They are kind of everywhere. You're absolutely right. So anyway, this one definitely catching investor attention. All right, Bailey?
Yeah, those are your gainers on an almost merger Monday, we'll call it, with some of those headlines. Want to start with some laggards, some of the worst performers in the S&P 500, starting with Fastenal, ticker FAST, much like Katie Greifeld was in college. Fast, Katie.
I used to be.
You used to be, but not anymore.
No.
But
you will be again.
One day.
You're I guess mile is probably like Fastenal in terms of getting lower in a bad way.
You were a runner?
I ran, just D3, but I ran all 3 seasons.
I had no idea.
Don't you run like 50
I
miles
didn't
a month?
know.
No, a week.
Oh my gosh, a week. Okay.
Okay, anyway, sorry.
Katie Greifeld, a college athlete amongst us. Fastenal, though, falling again. Call it almost 7%, worst day since October. This came after facing higher prices from suppliers, energy pushback. Fastenal makes some of those straps that fasten things in truck beds. So certainly a big bellwether for some of the industrials companies we're going to be keeping an eye on in terms of earnings. I also want to call out another one of the worst performers in the S&P 500, none other than Conagra Brands, ticker CAG. Guys, this comes after the Slim Jim maker is replacing its CEO after a 60% decline. I just want to feel for the guy, though, who steps into this spot, John Brace, and the stock falls even further. So not really a vote of confidence from investors.
Yeah. Hey, I just want to mention, going back to Dell and HP that we mentioned, definitely rallying on, talks that maybe NVIDIA would be interested. NVIDIA, 4:04 p.m. Wall Street time, saying the report on a PC acquisition talks, false. And says not engaged in discussions to buy any PC maker. So there you have it. So at least maybe that's not happening.
Yeah, I do want to shout out Jin Ho of Bloomberg Intelligence. We talked to him actually about an hour ago, and he said that, let's just say he was skeptical on this report. And now you have NVIDIA coming out and denying it, Bailey.
You want to know who's skeptical? Katie Greifeld, none other than David Solomon, talking about analysts setting too high of expectations. This came after their company reported earnings that they reported a surprise drop in bond and rates trading revenue, casting a shadow over another record quarter. So Goldman Sachs, ticker GS, down 1.9%. again, the stock, Carol, as we've been
not terrible compared, right?
Pretty sharply.
Yeah.
Over the last 12 months, up 77% even after the decline. So I think a lot of people would take that.
A little perspective.
I love CEOs sort of getting annoyed at Wall Street analysts. It's kind of like my favorite genre.
Well, don't they create their estimates based on their guidance?
Yeah, they talk like conversations with the company, body language, etc.
Yeah.
Come on.
It's kind of like giving signs in baseball. I guess Solomon was supposed to like touch his ear a few more times for bond estimates to fall down. But.
Something.
All right, let's get to some stories that definitely caught our attention. This actually has to do with the war. Toto, you know, the Japanese toilet maker, bidets and all that good stuff. Well, apparently they have suspended new orders for its prefabricated bathrooms due to a material shortage as the Iran war squeezes Bailey, the global oil supply chain.
All I want to say is, having spent 3 months in Japan, they have the best toilets ever.
You're preaching to the choir. Tim and I bonded when we first started working together because we both have Totos.
If you can't, I need a Toto installed in the Bloomberg office. I need one installed in my house. We need to figure out the supply chain issue,
Once you have a Toto, man, nothing else compares.
Katie, you need it. I know I've made it in life once we buy, number one, and number two, when we have a Toto with a heated toilet seat. Maybe that's TMI, but.
No, this is good. I'm glad that we're talking about this, but moving on, let's talk a little bit about Bill Ackman, because Bailey, we picked this out for you. You were one of the people behind this scoop that Bill Ackman has kicked off formal marketing for the IPO of his closed-end fund and his hedge fund. Bailey, is it really going to happen?
We think so. They set a pricing date for the end of April. Obviously, we went through this saga 2 years ago when it was going to be $25 billion, then about $4 billion, then about $2 billion, then didn't happen. But this time, they are incorporating Pershing Square proper as part of that to incentivize IPO buyers. So it'll be interesting. They want to raise between $5 and $10 billion.
All right. Well, there's some IPO activity, so maybe that's a positive sign. That's actually going to set us up for a conversation we're going to have on this side. All right, guys, you continue thinking about Totos.
Thank you.
You want to do
potty talk over here.
whatever floats our boats. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Katie and Isabel continuing there on the close on BTV, and Bailey and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And coming up, with peace talks crumbling between the U.S. and Iran this weekend, we'll discuss what's next with Puneet Talwar. He is former U.S. ambassador to Morocco. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Isabel Lee. Katie, it was such an interesting Monday. It was very headline-driven, and we saw a drip feed of news. And look at that. S&P wiped out 2026 losses. It's like the war never happened. And I know that may sound callous, but from the market's perspective, we're just seeing stocks rallying and rallying. To your point, you're right. The S&P 500 climbing 1% on Monday. We have now officially erased all of the losses we saw since the start of March when we saw the U.S. attack Iran initially. And this was really spurred, this initial reversal by the U.S. and Iran agreeing to a tentative truce. That was on April 7th. And I don't know if we got any closer over the weekend, but it seems like this is a market that just wants to rally. It just wants to rally, wants to believe what it wants to believe, and you see that in Brent crude. It's up at around 3%, around $98 a barrel, below the $100. I think it's an important psychological threshold, and now we're below that, and that comes even with Goldman Sachs stock also pairing those losses. Well, the S&P 500 erasing those losses. It brings us neatly to our top story this hour, and that is the U.S. beginning its blockade. President Trump imposing a full blockage of the Strait of Hormuz after peace talks collapsed this weekend. Here's what he had to say on the latest negotiations.
They'd like to make a deal very badly. We've been called this morning by the right people, the appropriate people, and they want to work a deal. They would like to work a deal.
Puneet Talwar, he is former U.S. ambassador to Morocco and former senior Iran advisor to President Obama. I'm pleased to say that he joins us now. Fantastic to see you.
Great to see you.
So let's talk about this blockade, of course, that going into effect at 10 a.m. Eastern today. How much leverage does this give the United States when you think about the cost, for example, to Iran?
It is obviously going to impose a significant cost on Iran, hundreds of millions of dollars a day, billions of dollars a month if it were to continue that long. So it's a significant in terms of the cost. However, I'm not really sure it's going to provide the kind of leverage that will finally get Iran over the finish line here. And if you just look at the last several weeks of bombing, which has been very intense, destroyed thousands of targets, that on its own has not caused Iran to cry uncle, as the president said. So it's very unlikely that this alone will do that. It needs to be paired with the diplomatic effort that began over the weekend.
Well, I was going to say, in your view, what would get Iran sort of past the hump here if it's not, the blockade of the Strait of Hormuz? I mean, what do you think would really get this situation across the finish line?
I think we have to prioritize. I think Iran also has to prioritize. What do we need out of these negotiations? Not necessarily what we want in an ideal world, but what do we absolutely need? And for the United States, what we really need is an assurance and an ability to verify that they will never get a nuclear weapon. And also we need the straits reopened. And that's, of course, a new issue. That didn't exist 6 weeks ago. It's only because of the conflict that we now have to deal with that. And so that's what we need. And in terms of what Iran would want, they want sanctions relief. They want an assurance that they won't be attacked again. And they want to also just be able to assure themselves that, they can manage with the United States in a different kind of environment.
When you look at the Strait of Hormuz, do you see it as a central bargaining chip at this point or a part of a much bigger standoff?
I think that it's the biggest bargaining chip that Iran has right now because perhaps they didn't realize it before the war started, and we didn't maybe even realize it. I think our military knew that this was very much something that the Iranians could do, and we'd been planning for it for many years. But when they actually closed it and the effect that they had on the world economy, they may have been surprised by that. So the two big bargaining chips they have are the Strait and the nuclear material that they now hold.
So what are we looking at now then? A prolonged stalemate, or do you see a near-term credible ending to this or agreement?
I mean, right now, there's a gap in positions, and that gap in positions is driven by the gap in perception. Iran believes it has the upper hand because it has the world economy in a stranglehold through the Strait of Hormuz, and it's continuing to hold on to that nuclear material. It's not going to give it up easily. And the United States, I think, after destroying thousands of targets in Iran, believes that we have the upper hand, that it should be Iran that is coming to the table. And so until that gap closes, and there are some inklings of that, there are some reports today that the United States moved a little bit closer to the Iranian position of wanting to have some limited enrichment capability, perhaps after 20 years. And so if that gap can be closed, I think then you could get to an agreement, and perhaps that's what the markets were reacting to today, is that optimism. I'm not that optimistic yet.
Yeah.
I think we have a long way to go.
Both sides think they have the upper hand. Sorry.
I was going to say, I mean, exactly that. The U.S. has made clear they think they have the upper hand. Iran, to your point, thinks that they do. That doesn't necessarily sound like a fertile starting point for resuming diplomatic efforts here.
Yeah. And the risk, of course, is with this blockade, is that Iran could respond and has threatened to against port facilities of its Arab neighbors, and basically saying, if we can't trade, then you can't trade either. And if it escalates like that, it gets a lot worse. And it again becomes more difficult then to put back in a box and get to that agreement, I think, that we all need.
And I'm curious to hear your thoughts on what pressure that Iran might be receiving from the likes of China here. We were having this conversation with Kyle Bass that you think about China, they are a key customer when it comes to Iranian oil and also a key trade partner as well. President Trump, we heard from him earlier today saying that he hasn't spoken directly with Xi Jinping necessarily about this, but his belief is that Xi Jinping would like to see this come to an end. So I'm curious what you think this means for the Iran-China relationship.
I think, obviously we've seen some reports also about weapon supplies potentially from China to Iran as well. It's just, they have a strategic partnership, a comprehensive strategic partnership, which is the highest level of partnership that China will have with any country. But China also has that with Iran's neighbors and adversaries, with the United Arab Emirates, with Saudi Arabia, and with Israel. It also has a very good relationship. And in fact, those three relationships that I just mentioned are more economically important to China than Iran, even though Iran supplies significant amounts of oil to China. China doesn't like to interfere in these kinds of regional disputes. Its modus operandi is to say, can't we all just get along here? Let's have a ceasefire. Let's go to that. But they have an ability to influence the Iranians. And I witnessed that when I was a participant in nuclear negotiations with the permanent 5 members of the Security Council plus Germany. And we saw that when China didn't speak up much, but when it did, the Iranians would listen carefully. And Iran has really been putting a lot of stock in the Chinese relationship. They've been hoping to get China on side. They have been also seeking a way to get China to counterbalance, and you saw that in fact with Iran trying to get the yuan being used for payments to move away from the petrodollar. I don't think China has fully reciprocated Iran's desire for that close partnership. So I would suspect they're probably pressing them, and at the right time, we might be able to use the Chinese if we get close enough here to help Iran get over the finish line.
Well, Puneet, we so value your expertise. Appreciate your time today. That is Puneet Talwar. He is former senior Iran advisor to President Obama. Now, coming up, to say the least, it's been a noisy start to the year for alternative assets. Aon Mulvihill, he is global alternative strategist at JPMorgan Asset Management. He joins us next. This is The Close on Bloomberg. Well, the equity market's knee-jerk response to each development from the Middle East is pushing investors to diversify. That includes in alternative markets where uneven global pressures have made way for opportunity, according to our next guest. Joining us live, I'm pleased to say, is Aon Mulvihill. He is global alternative strategist over at JPMorgan Asset Management. Aon, great to see you in person.
Great to be here. Thanks for having me.
So let's talk about how you weigh that pitch, that alternatives, they're a great way to diversify in times of geopolitical stress, with what we're seeing, particularly when it comes to private credit. You think about the SaaS apocalypse certainly shaking up a lot of these alternative managers, and I have to imagine putting a little bit of a cloud over the entire space.
Yeah, there's a bit of a sentiment challenge right now in private credit. I'm not sure is entirely justified, and that's coming from some things that we would certainly agree with, which is there's a large software component to private credit, but that's something that investors have to contend with in the equity markets as well as the debt markets. How do they feel about software, and is it something they want to have in their portfolio? But I think more broadly, private credit is paying a premium, continues to pay a premium to public credit. That's why investors are leaning into it. It's a source of constant return. And then when it comes to diversification, that's something that's been missing from public portfolios in the first quarter. We've had a good day in the markets today. We're up about 1%, but it's taken until April to get back into positive territory in the S&P. So portfolios that don't have any alternatives exposure, they've seen quarter one end with S&P down, stocks are down, bonds are pretty flat.
Yeah.
So without any alternatives exposure, there's not a lot of green in the portfolio.
Well, let's get specific here, because you think about the umbrella of alternatives, that is a very broad church. So specifically, you think about the past month, it's been a really kooky kind of market. Traditional fixed income hasn't really given you any sort of hedge. Where do you see the best places to diversify right now within that umbrella?
So investors are starting to lean into some of these asset classes that pay a constant return, have some inflation hedging characteristics. I think that's particularly important as we've seen oil over $100 a barrel. We've come slightly below that figure now, but as your last guest said, we're not out of the woods. This conflict could continue for a while, and that is going to feed into inflation. And so looking at inflation hedging assets like real estate that have been successful in passing on rent increases. We've all seen our rents increase. That gets turned, for investors in real estate, that gets turned into income. And then for an asset class like infrastructure, that's mainly invested in power generation. So, and again, we've all seen our electricity bills go up. For investors, that gets passed into income for their portfolio. So they're among the few asset classes in the green so far this year are those hard asset classes like real estate, like infrastructure that pay those constant returns and have some kind of inflation hedging characteristic to them.
All I heard in that answer was rent increases because I'm a renter, and there is indeed a steep rent increase every year. So if geopolitics can push oil up around 6% more or less and barely budge equities, in fact, we're seeing the equities, S&P at least, wiping out all of their gains for 2026. What is the market seeing, maybe, that most people aren't? Are we underpricing something?
In terms of oil, I think investors are taking another look at the energy component of their portfolios, because if we look long term, the expectation was oil prices are declining. We're going to get to pre-Iran crisis. We were looking at ending at $60 a barrel next year. That's no longer the case. When I look at future markets now, we're ending at maybe $75 a barrel, but we're likely to stay in the 80s at best case, looking at the future markets throughout the summer. And so, how do you play in this environment? You need to look into assets to give you some kind of a hedge against that. Shipping is one that has performed really well, both in the public markets as well as in the private markets, because if oil's got to get into our cars somehow, and it's not coming out of the Gulf, so it's coming from places further afield. Looking at countries in Asia, they're getting more oil from the U.S. They're getting liquid natural gas from the U.S. And so that's going into ships that are now traveling further to get to their destinations. So liquid natural gas, for example, 25% of it comes from Qatar. That can't get out of the Strait right now. And so it's being exported from places like the United States to other countries. And so for investors that want to benefit from this, looking into transportation, both either in the public side or in private transportation funds.
All right, Aaron, unfortunately, we're up against the clock, so have to leave it there. Hope to have you back soon. That is Aaron Mulvihill. He is Global Alternative Strategist over at JPMorgan Asset Management. I have to say, Isabel, I'm very excited to get into some of the earnings from these alternative asset managers, these big private credit firms, because as we keep hearing, I mean, maybe that was an undercurrent behind the negative reception that we saw to Goldman today.
Maybe, and we see headlines every day, and do these gates maybe raise questions about the liquidity when it comes to private credit? And you made a point earlier that where will investors go when they flee that space?
Yeah, absolutely. It seems like at least there was a mismatch in expectations when it comes to the liquidity of some of these vehicles. But coming up, volatility rising across multiple fronts. A conversation with Greg Case. He is Aon's president and CEO, about how the company is modeling risk. This is The Close on Bloomberg. Geopolitical tensions, economic uncertainty, AI disruption, these are just some of the many risks that investors and institutions are dealing with. Our next guest warns, quote, "We're operating in a more volatile environment, which requires integrated solutions to address rising challenges, build resilience, and grow." Here to discuss, I'm pleased to say, is Greg Case. He is the president and CEO of Aon. Greg, great to have you with us. Let's start, of course, with the geopolitics of it all. You think about the war in Iran. I wonder, when you bring it to your world, what specific line of insurance are you seeing the most tension on, if any?
Well, first of all, Katie, it's great to be with you and Isabel. Terrific to be with you today. Listen, I have to say, it isn't a specific line, Katie. It's really much broader than that. If you step back and think about sort of the evolution of the world in the last decade, we see some fundamental kind of mega trends which are really guiding the path for all of our clients. These are large clients, medium-sized clients, small clients. And it really is around, what's going on in broad-based trade, technology, weather, workforce. These four mega trends sort of drive really everything that's going on. And then the events that we're seeing, Ukraine, Middle East, and now, Katie, as you said, in Iran, these just amplify what has been set in motion against these mega trends. So for us, every one of our clients is thinking about how to understand volatility, understand the exposures they've got, and to take action. They all know, in the end, they can't pause. They can't wait for things to happen. They have to have a view, and they need to be able to take action against it.
Well, I hear what you're saying, that, it's not necessarily one specific line of insurance, but I have to bring up shipping insurance. I've probably heard more about shipping insurance in the past couple of weeks than I have in my entire life. And I wonder, what you're seeing there, what that potentially means for Aon.
Well, listen, from our standpoint, again, Aon is all about our clients in every way you can imagine. And if you think about it, shipping connects with broad-based trade. It connects with sort of application around technology, implications for what's going on with talent as well. So these These trends I'm describing, seriously, are all truly interconnected, very, very, very valuable as you think about sort of what you do day to day as a company in commerce. And our world is to literally, keep the lights on. We've got to make commerce happen. We've got to make, the economics have got to work. We've got to keep the world open for business. And so for us, from a marine standpoint, there is trade happening. There's insurance happening. But we're looking for broader-based ways to reduce the volatility of the overall situation, not just passing through the strait, but also what happens as we evolve out of the current crisis and go to a more of a day-to-day, general business management. So we're looking across the piece here on a client-by-client basis.
Talk to us about the growing gap between economic losses versus insured losses. In your notes, you wrote that climate, conflict, and cyber risks are becoming harder and more expensive to insure.
Well, Isabel, if you think about sort of what's going on right now, in the end, the opportunity for us in a world which has become more volatile, we believe is profound to support clients. Again, understanding volatility, understanding exposure, and then taking action against it. The challenge is, when you think about the entire insurance world, this is essentially a set of balance sheets added fully together is about $4 trillion US dollars. When you think about sort of the risk here and the exposure, it's much, much greater than that. So how do we use analytics, content, insight to actually drive solutions which will actually draw more capital in? So, for example, we're also drawing in capital beyond the insurance world to the pension world, the sovereign world, the PE world. This is a $250 trillion pool. We recently did a cat bond, for example, for Jamaica, which put $150 million into the economy post the Category 5 hurricane in a way that drew more capital in. So this divide, this gap around sort of what's covered and what's exposed, the way you shorten that gap, you draw that gap in, is you draw capital in, and you do that through analytics, and that's what we're trying to do.
So what are clients doing now? Are companies pulling back investments due to these risks? Talk to us about how they may be increasing spending on hedging or insurance, or are they pulling back on more of those cases?
Well, listen, capital doesn't move, Isabel, unless it believes it can make a return, and it's protected. But when it believes it can make a return, all kinds of wonderful things can happen. And this is how we've used analytics and content and capability to draw more capital into the risk industry than really ever before. When you think about the cat bond I described, there's $136 billion now going through this category that didn't go through a decade ago. So this is the opportunity. More insight, more content, more solutions. What we're doing on data centers, for example, is drawing capital in, both traditional and non-traditional, in a way that's never been done before to close the gap that you're describing.
I'm glad you brought up data centers because that's where I wanted to go. There was a recent report out from S&P Global Ratings really highlighting data centers as a potential $10 billion area of opportunity for insurers. So talk to us specifically about how you're planning to navigate that space. How much appetite do you have to take on all of that new risk?
Well, this is, again, back to the idea of understanding true exposure and then being able to draw capital in to address it. As we think about the data center opportunity, this is truly an unprecedented investment in the history of the world. And it really isn't just the hyperscalers. It's the hyperscalers, the builders, the capital that's coming in, the funds, the banks. This is an ecosystem wrapped around energy and talent and water that all comes together. Our view is the analytics mean you can actually understand the volatility that drives that entire ecosystem. And what we're trying to do is actually reduce that volatility. If we can do that over the life of a data center, that's a very, very powerful outcome that increases capital return. And as you think about it, it also ties back to the talent point I made before, the workforce piece. Because our view is, listen, there's no success on AI application unless it's led by a talent strategy, a world-class talent strategy. So for us, we're looking across that entire ecosystem as we think about the opportunity to bring capital in, apply it in a way in which it gets a better return, less volatility, and works with the overall talent strategy of a firm. So for us, this is a tremendous opportunity, and we've taken great steps to pursue it.
How are you approaching potential partnerships when it comes to that space? Because, reading into this S&P Global Ratings report, they do highlight that, we're talking about such large risks that no single insurance can take that on solo.
Completely correct, Katie. Great observation. Again, think about it. The entire insurance world, all the balance sheets are $4 trillion. we're accessing now the 4 trillion plus 250 trillion. We've got a data center facility we've developed out of London, which is really bringing capital from all sources to bear on behalf of this overall opportunity. So it truly is going to be about how you can bring the right amount of capital in to reduce the volatility in a way that makes it more economically viable for those participating. And the answer to that is content, it's insight, it's analytics. And what we've done literally for the last, better part of 10 years, really driven. By the way, we put the first NVIDIA chip into a Pathwise investment we made in 2009. So for us, we've been seeing this evolve over time. Now we see great acceleration. But the analytics is what draws the capital in, which creates the opportunity and the capacity to begin to address the level of volatility that comes with the data center development.
So, Greg, you sit at the center of global risk. What's one exposure keeping CEOs at night that you think maybe isn't priced into markets just yet?
Interesting. I must tell you, Isabel, we do a risk management strategy or review every 2 years, and we look at we tap into all the risk managers all around the world, 3,000 plus. It's a tremendous database. And so you've seen geopolitical actually rise over the last 5 years in a way it's never risen before. But cyber continues to be at the forefront. What really is this exposure? How is it evolving over time? The overall market's only about a $15 billion market against a $1 trillion potential exposure. So again, we're using analytics to sort of address that, help our clients understand what that volatility could look like, how much they should absorb themselves, what they can mitigate against, then how much that actually they should buy down with a solution or a product. And for us, this is probably the most proximate we see every day, although I must stress these 4 megatrends I described before, this interconnectivity of them is really what drives the overall risk profile that clients are dealing with every day.
All right, Greg, really appreciate your time on this Monday afternoon. That is Greg Case. He is the president and CEO of Aon. Meanwhile, let's take a quick look at how markets closed on the day. A big rally for the S&P 500, rising by 1%, erasing all of the losses that the index suffered after the U.S. attacked Iran just at the end of February. You saw a little bit of a rally in the bond market. 10-year yields down about 2 to 3 basis points. That's as Brent did rally a little bit here, but we are below $100 per barrel. And Bitcoin getting in on the party as well, higher by about 2.6%. This is The Close on Bloomberg.
Earnings season's kicking off at a crucial time for stock traders whipsawed by war and AI threats. Bloomberg's Michael Ball says earning expectations are buying equities time, adding that stocks are likely to keep absorbing bad political news as long as management teams validate the profit story and oil stops pushing inflation higher. Joining us now to discuss is the man himself, Michael Ball, Bloomberg macro strategist. So talk to us about how stocks are just shrugging off all the worries. I mean, we ended the day with the S&P making a round trip and erasing all losses for 2026.
Yeah, it's really been interesting since Wednesday. Really, it's been greed over fear again, and it's interesting to see how that momentum keeps building on itself, and more participation now is coming in the market. So we obviously had a mechanical kind of short covering last week as everyone sort of reassessed what the long-term damage from this current situation would be, and we kind of clipped some of the tail risk. Now, coming out of this weekend, everyone was worried again as it looked like nothing got done and things were right back to where we were before. But obviously, President Trump came out today, gave a little bit of a nod that he was doing his maximalist negotiation tactics to kind of de-escalate, and people grabbed onto that. And Iran seemed to have some murmurings, too, that they were willing to concede some points, which they weren't earlier. And lo and behold, oil started going. That's all you need for equities.
Right.
We took another leg up, and again, more participation came in. And this time we saw some real buying, actually, not just this kind of short covering rally, but actual guys look like from the buy side. We're getting some prime books. Some dealers were telling us they were seeing people picking names and trying to hold longer.
Well, let's talk about oil a little bit, because I'm looking, at sort of the thesis that you lay out. Management teams, they need to validate the profit story. Sure, that's on them. Oil needs to stop pushing inflation higher. That feels like a much bigger wild card here for these C-suites.
Yeah, I think the worry should be the pain trade is that we do melt higher into this earnings season, to your point, because the actual effects take longer to hit. So we're going to have earnings come through. We're going to have management say, so far it looks okay. So far we're not seeing any kind of margin pressure or the consumer really pulling back. We make new highs, maybe in a couple weeks, months, who knows. And effectively then we see the real effects of the tighter product market that was starting in Asia, hitting Europe, and eventually will come to America. And we've kind of already picked up on all of those crosswinds, but we just don't know how long it actually hits current activity.
So around 30 seconds here. If we see heightened volatility, which asset class is more at risk? Equities, credit, or is it something less obvious?
It's a great question. I think right now equities probably would be again at the forefront of selling off. But again, it's very unclear what the day-to-day kind of signals would be for markets to really get negative again, because there's just a lot of noise. So to your point, credit seems to have hung in better. Equities seem to be a little more volatile. But then again, we've now rebuilt back to pre-kind of Iran ranges, which have had very good sticking power prior to this.
All right, Michael Ball, always fantastic to see you at the desk. That is Michael Ball. He is Bloomberg's macro strategist. Meanwhile, we mentioned earnings. Let's dig deeper into the first group reporting, and that is the banks. Tough to glean what lies ahead for JPMorgan, Citi, and Wells Fargo's results tomorrow after Goldman's report today. A surprise drop in bond trading revenue despite a record quarter for the equity guys. Joining us live in studio, I'm pleased to say, is Scott Siefers. He is Senior Research Analyst over at Piper Sandler. Scott, it's great to see you.
Great to be here. Thank you.
So before we get into some of the specific banks, I do just want to set the scene here, because as we've been talking about over the past hour and a half, you think about financials coming into this week, the worst performing sector on the S&P 500, despite volatility theoretically helping some of these trading desks. What do you make of sentiment right now?
Yeah, it's kind of interesting. To start the year, sentiment was excellent, probably as good as I've seen in the last decade for the banks. We've really sort of round-tripped that, right? So if you think about what we thought at the beginning of the year, everything looked like it was sort of blue skies. We had loan growth looked like it was going to come in well, investment banking, very benign rate environment, credit, and then new capital rules coming. So everything looked great. Obviously, that feels like a lifetime ago at this point. So some of those things are still popping, and it will probably go well, but there's, of course, this new wall of worry that we're all concerned with. And bank stocks, I've done this long enough to understand that really investors treat them as just expressions of either a macroeconomic view or an interest rate view, and that has changed completely, of course.
Yeah, it's something that kind of frustrates me when I think about, financials, because when it comes to how they trade, I mean, we see this, it feels like every earnings season. They come out, they make money hand over fist when it comes especially to trading, and then the stocks don't really react in the way you might expect. So, I mean, what is the key driving catalyst here for this sector?
Yeah, so great question. I'm not sure any of us knows for certain. However, we can make some educated guesses. So I think first we need to see some sort of narrowing of the volatility, right? I mean, everything has changed with the Iranian conflict. So that's put into question credit metrics with things like the strength of the consumer. It's put into question customer behavior, meaning corporates in terms of loan growth, in terms of investment banking strength and things like that. And the rate environment has changed as well. We came into the year thinking we would get a stair step of a couple cuts. Now it looks like maybe no cuts, perhaps even a hike. So now that'll be good for the universals, meaning the largest banks out there, but for the regional banks, probably not as much. So really what we need to do is sort of narrow the cone of outcomes here, and that's the first step, I think. Having said that, the banks themselves I think you'll see, are going to be very, very resilient and post some pretty strong quarters as well.
So what are you watching most this earnings season then? Investment banking, trading, or credit quality? We're going to see a slew this week.
Yep, really all of the above. So the first thing I'll be watching, I think, for the largest banks, as I suggested, their trading revenues should be really, really strong given all the volatility. That's number one. Number two, customer activity has been pretty good, and that'll manifest itself in strong investment banking activity and strong loan growth as well. So that'll help both the universals and the regionals. I think credit overall is actually going to be very stable, and that's despite some of the negative headlines that you've heard as well. So good quarter overall.
I was going to ask if you're seeing any signs of stress yet when it comes to loan books or corporate lending.
Really not so much. So consumers have been extraordinarily resilient. There's been this notion of a K-shaped economy that's very real. Higher end consumers have been doing very, very well, while there's been stress for some time at the lower end. But in the aggregate, the consumer has held up very, very well, number one. Number two, on the commercial side, I'd say resilience has been the key as well. I think in many ways, COVID a few years ago served as sort of a dry run to deal with all this volatility, and they've managed to get through very, very well.
Yeah, there are some interesting parallels there if you think about it when it comes to this specific period in time. But let's get specific here because we got Goldman out of the way today. You look ahead, obviously all the big banks set to report in the next few days. Talk to us a little bit about JPMorgan, since that's one of the names that you specifically highlighted in your notes.
JPMorgan should have a good quarter and a good outlook as well. I mean, to start, if we go at 30,000 feet, JPMorgan is always a great defensive name in times of uncertainty. So that's number one. But let's boil it down a little more to the near term in this year. So their trading book, they're one of the scale markets players. That should be really, really strong. They gave an update back in February. If anything, things have probably only gotten better since then. And I'd say the same thing on the investment banking side. So they're well positioned on both of those. Moreover, I talked about this idea of a higher for longer rate backdrop. The universals and JPMorgan in particular tend to actually be advantaged by a higher for longer rate backdrop. So I think some people are looking for the possibility of a raise in their net interest income outlook for the full year. So basically, I think what you've got is probably a conservative set of assumptions, potential for a beat and raise, and it's a great defensive story. Plus, they have a lot of capital as well that should get deployed over time. So really good all around.
Do the past days change the outlook for banks this year, or is this as good as it gets?
Oh, good. Excellent question. I think at a minimum, banks will be able to weather this volatility pretty well. However, the longer this uncertainty goes on, the more of a question mark things become. Again, loan growth, investment banking activity, et cetera. And at some point, if this volatility doesn't die down and the macro outlook doesn't calm, then customers will get a little more stressed and we'll have to worry a little bit more about things like credit quality. But for the most part, I think you're going to see good quarters, probably some cautious optimism about the outlook, and so much of it is just going to be macro dependent.
And before we let you go, I do want to talk about deal making in the context of the financials industry specifically, because, you know, we've started to see some consolidation, but you think especially about some of these big headline names coming in the next few days. What do you think that their appetite for M&A is at this point?
Excellent question. So this is one of those other places where at the beginning of the year we thought it was going to be one thing and it's turning into something else. Now, for the largest names, they'll largely be bystanders. At JPMorgan, B of A, they're above the U.S. deposit cap, which means they can't do deals. Now, Wells Fargo, probably low odds, but they could do something. The large regionals, that's where I think you're going to see a lot more activity going forward. You've seen a couple big banks get even bigger. Fifth Third, for example, buying Comerica, Huntington buying Cadence. So I think there are others on the sidelines that would like to consolidate, generate a little more scale to compete with the likes of JPMorgan, B of A, and Wells Fargo. So stay tuned. I think we thought it was going to be a lot more active. Right now, all this volatility, unfortunately, has kind of generated a little bit of an air pocket, but stay tuned.
All right, stay tuned. That's a good place to leave it. Scott, great to get some time with you.
Thanks again.
That is Scott Siefers. He is Senior Research Analyst over at Piper Sandler. Now, coming up, what investors need to watch for over the next 24 hours, we'll tell you next. This is The Close on Bloomberg. All right, let's take a look ahead to what else we're watching over the next 24 hours. And Isabel Lee, it's a busy one when it comes to the pre-market earnings slate.
Super busy. We have JPMorgan, Citi, Wells Fargo, BlackRock, our favorite. I mean, you're probably the only person in the world as excited about ETFs. Whenever I talk ETF to my husband, he's like, it's only you who's excited. And I'm like, me and my team. Johnson & Johnson's and CarMax.
Exchange traded fund, that's what we call it in the Greifeld-Seiler household. I am interested to see these earnings from these big banks, especially from Wells Fargo, freed from their asset cap. We are going to speak to the CFO of Wells Fargo on this program tomorrow at 3 p.m. Johnson & Johnson, I'll also be interviewing the CFO. That's at about 10:45 a.m. tomorrow morning. So a really busy earnings slate here. Also a busy economic slate as well when you think about what's in the pipeline.
We have PPI, NFIB, small business optimism, and we have the IMF report, actually, and that's what I'm most looking forward to, especially after... Yes, because the IMF will lower its global growth forecast as a result of the war. I mean, that's pretty grim.
Yeah. Yeah, it's an interesting time to, try to game together the economics of this situation, because you've seen the market reaction. The S&P 500 now is fully shaken off what we've seen unfold over the past month. But when it comes to the lasting impacts here, you think about sustained higher oil prices near $100 per barrel. Certainly that's going to have an impact on global growth. And we'll probably hear about that from some of the Fed speak we have on deck as well.
We have Fed Goldsby actually talking to one of our competitors, saying that the length of oil shock is key to economic impact, and saying that should energy prices remain elevated, well, it would mean a lot of really negative consequences.
Well, we'll hear from Goolsby again tomorrow, as well as Barr, Paulson, Collins, and Barkin. But that does it for us for now. Balance of Power is up next. Have a great evening. This is Bloomberg.